Hey, Rent to Retires, it's Adam Schroeder here with Rent to Retirement, and today we are going to talk about your investment property's RAMP versus its RAPP. Quick reminder before we get started with the video, please subscribe to our YouTube channel, click the notifications. We're trying to educate you and make you the best investor that you can possibly be. We're putting out content to help you along the way, and you don't want to miss any of it, so do that right now before you finish watching the video. At the end of the video, please like the video if you think other people will find it useful. Leave a comment if there's any questions you have or any topics you want us to cover on future videos, and we will get to it as soon as possible, either on this YouTube video or on our podcast we're putting out twice a week that you can find at renttoretirement.com. So let's get into it. I mentioned RAMP versus RAPP. What in the world are those? Well, they're metrics that you've heard of, but maybe not quite in this way. So RAMP stands for rent against market price, and RAPP stands for rent against purchase price. So what does that mean exactly? And when do you use these metrics? So you may have heard of the 1% or 2% rules or something along those lines. And it's quite simple. It's a quick, dirty calculation you can do. If you notice, all of these things I'm talking about when it comes to real estate are, what do I say? It's just a mathematical equation, right? And so is this one. Rent against purchase price, or RAPP, is when you look at it, it's your rent divided by your purchase price. So if you have a $100,000 house that gets $1,000 a month in rent, you have $1,000 divided by $100,000. And when you convert it to a percentage, that gives you 1%. Now, when you're looking at properties, quick and easy, you can look and say, okay, if it's 1% rent against purchase price, well, that tells me there's a good chance it's going to work out numbers wise. It obviously doesn't work across all markets because of property taxes and all of the other things. You know, if you have to have really expensive home insurance, it also depends, on a whole variety of factors. But a 1% rent against purchase price will give you a pretty good ballpark that this property has a chance at working out. Dig a little bit more into it. When it gets less than that, which new construction a lot of times is less than that, it can still work, but you need to start running your numbers just a little bit tighter just to make sure that everything's good. If it's above that 1% rent against purchase price, there's a good chance you're gonna, have a really good investment property on your hands. Just know that lower doesn't necessarily mean it doesn't work, but you want to dig into it a little bit more. So what's RAMP? Well, RAMP is rent against market price. Why is that different? Well, on the day you closed on your property, the two are, if you're buying turnkey, the same. If you're buying a wholesale or going to do a flip or something like that, they are the same at the day of, but they could be very different in 2, 3, 4 months down the road or whenever you finish your flip. Because the market price, you're buying it below market because you have work you have to do on the property. But if you're buying turnkey or anything like that, the day you buy it, that is the market price. But a year down the road, your $100,000 house probably won't be $100,000. Maybe it's $105,000. Maybe it's $98,000. Market doesn't always go up, although in today's environment, it's going to be going up for a while. But maybe it's $105,000, $104,000, and suddenly it's not quite the 1% rent against market price, but it's just a little bit lower. So when would you use this? Well, there's a couple of different things. Number one, when you use your rent against market price, you can see if your rents are able, or how close they're able, to keep up with the appreciation in the market. If appreciation is far surpassing your rent increases and your ability to keep up with it, well, it might show you that you're in a market and you have a property that's ripe for a 1031 exchange. It could tell you, hey, it just won't work. It's such a good investment now. It was such a good property and it has such high demand that you're not going to be able to keep up with it. Now, that can mean great things for you when it comes to either doing a cash out refi or doing a 1031 exchange, or the likelihood is, as your market price goes up in the area, your rent's going to go up as well, but it's not going to keep up at the same pace. So, maybe your 1% rent against market price at your purchase date is now a 0.8% rent against market price because of appreciation going faster than your rental increases. If you look historically, you're talking about roughly a 6% appreciation rate across the country, and rental increases are usually more along the lines of 3 to 4% in a lot of cases. So it's going slower, but it's always working to keep up. So you can also use the rent against market price to see if you're selling it to another investor, which you don't have to do. You can sell it to a home owner occupied tenant as well. But if you're selling it to another investor, might they have any interest? Can they make your property cash flow on the day they buy? If you bought it for $100,000 and $1,000 rent, you're making $200 a month cash flow, which is very easy, very doable, but it might be a little bit low for your standards. But if suddenly that property is $200,000 and your rent's only gone up to say $1,100 because the market's so hot, but the rents haven't kept up, well, are other investors going to be interested? Well, with the increase in the premium they're going to have to pay their mortgage payment every month, they may not be as interested. So you're going to be focusing on selling to homeowners, to owner-occupied people, not investors. Now, your rent against purchase price isn't just useful the day you buy it. It's also an interesting way to look at it and track and see how your investment is performing over time. Did you originally buy with a 1% rent against purchase price and now you're at a 1.7% rent against purchase price? Okay, it's gone up 70%. Well, how long has it taken to go up 70%? Are you in a market that you're able to increase your rents 3-4% a year, or are you in a market you could increase them 10% a year? If your rent against purchase price continues to climb and climb and climb, it's going to tell you, hey, this is a good investment. Maybe I want to buy more properties in this market because it's doing so well for me. So the rent against market price, the rent against purchase price is just a quick glance that you can look at your property to see how it's been performing either since you've bought it or compared to how the market's been doing since you bought it. I hope this has been helpful. If it has, please click the like button, leave a comment below, tell us what you thought of the video, or if you have anything else you want us to cover, we will get to it as soon as we can. Also, don't forget to check out our team members. We can help you plan out your real estate plan, investing in the future. You can go to renttoretirement.com to see what inventory we have and get in touch with us there. If you want our pro formas sent directly to your phone, you can go to renttoretirement.com/hotlist and subscribe to that podcast feed. They'll get sent to you as soon as we put them up there, which we try to do pretty much as soon as they're up on the site. So renttoretirement.com/hotlist will get you those. Don't forget to subscribe to our YouTube channel, click the notification bell, and I'll see you on the next video.